Good day, and welcome to another exciting episode of Trading Edge with myself, Terence Hove, Senior Financial Market Strategist at Exness, and my colleague, Sihle Tuta, who is Commercial Director for South Africa at Exness. And today we are going to be talking about trading, commission, and fees, and what it all means for your trading business and experience, including journey. And as always, please remember to follow us on all our socials. And don't forget to subscribe, like, and comment. Yeah, welcome, Sihle. How are you doing, mate?
Great in yourself, Terence. How are you doing, man?
I'm very well, thanks. So today we're going to be talking about trading, the commission, fees, and what that all means for trading business, traders' experience and journey. And so, what is it? What is commission? What is fees in trading?
So maybe let's start by saying that trading is a business, right? It's a business for the trader. It's a business for the broker, right? Traders make money by placing profitable trades. If you place a trade and you're on the right side of the trade of the market, if the trade reaches your take profit, then that's how you make money, right? Brokers, on the other hand, make money by charging a spread, by charging some fees, and by charging a commission, some sort of commission, right? Now, a spread is the difference between the bid and the ask price, which is a fee then that gets charged to that specific trade, which then goes to the broker. Like Exness, as an example, will typically charge a spread on some accounts a commission, depending on whether it's a long trade, a short trade, whether the trade lasted overnight. There will be a sort of commission that is charged on that. Some brokers will institute some sort of fees, calling them different names. Either way, it's basically a fee that a broker charges you for placing your trade in the market. So you will see in some cases, the moment you place buy or sell, your trade is already in a negative position, which is when the broker charges that fee. So a spread is basically the difference between the bid and the ask, and the spread can vary depending on the instrument you're trading, depending on the time of the day you're trading, and obviously depending on how frequently you're trading, and also depending on account type. So different account types have different types of fees. Some charge spread, some charge commissions, and some may charge a specific fee. Now, depending on the account type, obviously you choose when you're picking trading will determine how much trading costs you pay. And how frequently you trade will also depend on the trading costs you pay. The instruments you trade will also determine how much you pay in spread and commissions. As an example, many brokers, when you're trading with a broker, it will be very expensive to trade, meaning that the spread will be wider, the commissions will be higher if you're trading exotic currencies. Now, exotic currencies are basically currencies that belong to emerging economies, like South Africa as an example. If you trade the rand at specific times of the day, you will notice that the spread you pay is very wide. It's not necessarily because the broker is expensive to trade with, but it's because of the currency you choose to trade. Secondly, again, making an example with the rand or any other exotic currency, when you open a trade at market open or at market close or late at night, you'll notice that the spread really widens.
Right.
So these are all the fees that you can generally expect to be charged: a spread, a commission, or some other fee whenever you're trading any of the instruments that are offered by most retail brokers.
Okay. So the fees is the difference between the bid and ask price, the buy and the
spread,
sell, the spread. But why is spread charged? I mean, why is it charged?
So remember, the broker is in business,
Right.
They also have to get paid for their services, because otherwise, if you bring your capital, right, from wherever it comes from, and you open a trading account, right, and then you trade your capital, right, and then you make a profit, right, and then you withdraw all of your profit, right, you've made money. But how does the broker get paid for offering you that service? Because they put your trade in the market for you at almost guaranteed the price that you requested. So how do they get paid? Because you don't share your profits with them, do you? you know. So that's how they make money.
Probably not.
Yeah,
Yeah.
so that's how they make money. That's how they get paid, by charging the spread.
Okay. Okay. And the spread is then the revenue that the broker makes.
Yes, that's
Right.
correct.
Are there any other fees that are involved over and above the spread?
Well, depending on the instrument you're trading, depending on the account type. So generally, the business model of most retail brokers is either they charge commissions, they charge a spread.
All right.
Yeah. And because a lot of people will think that brokers will make money by charging transaction fees whenever you depositing and withdrawing. Like for instance, with Exness, they won't charge you transaction fees whenever you withdrawing or depositing. So the business model or how a broker makes money is through spread. Yeah.
Okay. So spread is a very integral part
Yes.
of trading. And then, so what is then the difference between spread and commission?
So a spread is charged almost immediately when you open a trade in most cases. That is why I said whenever you take a buy or a sell, you will notice that your trade will go into negative, which means there is a fee that is charged right there and then.
Okay.
Whereas a commission is
right,
usually charged when you hold a position overnight, right? And then you'll see that the commission is charged on each transaction for every transaction that you hold over midnight.
Yeah.
Right? Based obviously on the instrument you're trading and the account type you have.
So these are what are also called swap fees, is that
Yes, also can be called swap fees or swaps. Yeah, swaps overnight. Yeah,
Okay.
Swaps, which gets charged automatically on the trade that you keep open overnight. Swaps can be positive or negative because sometimes, in some cases, also depending on the instrument you're trading, the swaps can be positive, which means you get paid that interest, or they can be negative. So you basically want to look at this as your cost of doing business, right? Because you have to pay on the lights. If you're running a normal business, you have to pay your water, you have to pay your lights, you have to pay all the other utilities, right? Because these are your costs of doing business. The very same with when you're trading, there are costs that are associated with managing or running your trading account, depending on your style of trading. So either swaps, commissions, or spreads. Other than that, you shouldn't really expect to be charged any other fee.
Right.
A responsible, professional broker, you can expect to pay one of these fees,
Yeah.
depending on the account type, whether it's a spread, commissions, or swaps. Maybe there could be some other fee, but it needs to make sense. It cannot be just a huge amount of money that is unexplainable or unjustifiable. But we have to acknowledge that brokers are in business, just like a bank. If you have a savings account, a credit card, a check account, there will be an account fee. There will be a transaction fee every time you withdraw cash. There will be some sort of fee because that's how banks make money. But obviously, we can't compare a bank to a broker because a bank is in the business of lending. A broker just executes your trades on your behalf in the market, and that's basically what you pay for.
Okay. So in part of your trading journey, it's now more than just your profit and loss. So your profit, there's still an line of expenses, and you need to be mindful. Although they are instantaneous, they're not really visible.
So,
Yeah.
look, that's always an argument I've always found very peculiar, right? Because if you look at the cost of spread or commissions or swaps, it's usually amounts that shouldn't break the bank, right? So if you know what you're doing, a spread shouldn't really be that much of an issue, unless, of course, if you are a scalper, which means if you take hundreds of positions within the day, then you really want a trading account which is as cheap as possible, something like a raw spread account or something like that, because you're taking multiple trades.
Yeah.
But for somebody who's a position trader or a swing trader where you open one trade and hold it for a couple of days, a couple of weeks, where your profit potential is big, you really shouldn't stress much about the spread if you have the right account type. Just like how if you're running a restaurant, or you own a shop, you should factor in that you're going to pay for lights, you're going to pay for water, there's going to be utilities. Obviously, these utilities have to be within reasonable limits, right? You need to look at what all the other shops or other restaurants are paying in their neighborhood just to get an idea. obviously, in the retail trading space, brokers will charge different fees because they have the leverage, obviously, to charge what they want to charge for the services they offer. But there should be a standard or a benchmark. You can't pay 2 pips, as an example, for trading Euro USD with one broker and then pay 20 pips, when you're trading the same instrument, same lot size. There needs to be some sort of a benchmark, which then gives you an idea of how much you can expect to pay, in spread. Also, what you have to keep in mind is that many brokers tend to widen the spread at the release of economic news. So around news time, you see that because there's a lot of volatility that happens, the spread tends to widen. Now, spread widening means that it becomes expensive to trade. If you're going to be opening a trade a couple of minutes before a news release or a couple of minutes after a news release, the spread will widen. It's common practice. It's not really that maybe the broker is being bogus. It's normal practice, which is why then you may want to avoid opening trades or positions around economic high
It's
impact.
more expensive.
Yes, around high impact economic news. I mean, if you are already in the trade and you holding it for a couple of days, then I think as long as obviously within the risk management parameters, you should be okay.
Yeah.
But ideally, you'd want to avoid opening and closing trades around that time, unless, again, if you really know what you're doing and you know how much it's going to cost you.
That's an interesting point, Sitley. And I remember the one time I was going through some financial market training. I remember when I underwent, one of my many financial market training courses. So the facilitator and the program manager, and probably some who've attended this course will remember, he likes this phrase, nickels and dimes, nickeling and diming when it comes to trading, which is in another phrase, penny pinching, where you are trying to, make sure one pip is not lost unnecessarily. And he said, look, if you want to penny pinch in trading, you will have a miserable time.
Yeah.
And because I think that is the example. When you open a trade during high impact news, all it means is it's an expensive trade.
Yeah.
Can you afford it?
Yeah.
That's it. Not to call Sitley and say, Sitley, why are your spreads so high during high impact? That is the name of the game, right? So it's to simply say, look, it's expensive because there's a lot of risk in the market. So for you to buy those dollars or to sell those rands, it's going to cost you more than it would usually cost you because the market is moving a lot.
Yeah.
And if you know what you're doing, that money will come back. You open the trade where you open it, and that expense will be swallowed up by the profit that you'll make. And that's a very important psychological way of looking at it, Sitley, because often people see that spread as the broker trying to squeeze them out.
Yeah.
And often what is happening is traders are opening trades they cannot afford to open with the hope of taking a jab at the market and hoping, not, skillful enough or strategic enough to be sure or reasonably sure that this trade is going to make money. But it's a hope trade where they are saying, and that's why the spread becomes a very painful thing because you're penny pinching.
So I always find that very funny. And I think that way of thinking is very shallow because then, so you want to do business for free, literally, or pay next to nothing, because let's take a detour here as an example, right? If you look at all the businesses or all the industries or all the sectors that are available where people can potentially make a decent ROI, right? Now, we measure ROI in percentage terms in all businesses. What is the percentage return that you made in your property when you're renting out property, or you're buying and selling, I don't know, lollipops? You bought the lollipop for R1, you're selling it for 120, your ROI is at 20%, right? Trading, I think for those who do it well, has a decent ROI. But let's look at the costs that are involved in the trading business as opposed to another business. In most businesses, you have to invest in the inventory, in the stock, you have to hire people, there's the compliance, there's all this, a list of expenses that you have to look after for you to be in business. Now let's look at trading. You could literally run a multi-million rand business from the comfort of your own home. What are the tools you need? You need a laptop, which is not even a cost because a laptop is a personal tool that you would have had even before you started trading. You need an internet connection. Again, it's not a trading cost, it's a home cost, right? It's a necessity for most homes. And then obviously you need the education, the skill and the knowledge, okay, which you need to invest in, which is, some can argue that it's
Like
one
any
of
business,
like any business. And then obviously you need the capital, right? So the laptop and the knowledge of the internet, we can say it's a once-off cost, right? And the capital, right? You acquire the capital once, whether it's an inheritance, whatever the case is. So the ongoing costs of doing business are very minimal if you compare trading to all other businesses where you have to pay rent, where you have to pay staff, and where you have to feed them, where you have to pay municipal expenses. So paying a spread is really not something a professional trader should be worrying about if you consider how low the costs are of being in business as a trader. As long as you are trading responsibly and assuming that you are now profitable, trading costs should take care of themselves. So I don't understand traders who bicker about spread when all the other costs are next to nothing.
Yeah. I think, the great thing about this episode, Sitle, my key takeaway is the way you've explained what these fees, spreads, and commissions are, and how they come about. Because I think that understanding is what's lacking in a lot of the trader communities, to understand what it really is. That because it's not that there's facilities being provided, infrastructure that is being provided for you to be able to execute the business. That comes at a cost, and that is that cost for you as a trader, to partake in the game. And it's no different from anyone, from any institution. In fact, as you say, it's even more. When you really take it to those levels of a hedge fund, then there's regulatory fees, ongoing, fees of this, that, and that nature, So I think that is where maybe the gap might have been. So once that gap is filled, right, how do I proceed as a trader in terms of managing these costs of doing business?
So, Terence, just like when you're opening a bank account, right? You don't just, nowadays you can open a bank account online without having to visit a branch. You can go to an app and open a bank account. You have to look at your personal needs, right? What kind of bank account do I need? Do I need an account that's going to be low on fees because I withdraw cash a lot? Or do I need an account that's going to be friendly because I transact a lot? Or do I need an account that is friendly when I'm traveling abroad so that I can, I can use my card abroad, or whatever the case is. You know what your needs are. The same thing with trading. What are your trading needs? What is your trading pattern? What is your trading style? Do you open a lot of positions within the day, open and close as a scalper? Or do you take a few positions and hold them for a couple of days? Or do you take one position and keep it open for an entire month? So that decision will guide you in terms of the account type that you choose and the trading costs that it attracts. As an example, we mentioned a raw spread account, which Exness has, which is more suitable for scalpers, for people who open and close multiple positions. So if you go to the Exness website, you go trading and account types, it should give you each account parameters, and then you can decide based on your trading style, based on your trading needs, that you should be able to decide which account type is good for you. Just like when you trade using algorithms, trading bots, which have the capacity of opening and closing hundreds of positions within the day, that you should know which account type is suitable for you based on the fee structure of that account, and also the instruments you trade, because the instruments I don't charge the same. Some instruments are more cheaper to trade than others. As an example, we have the five majors, two of them being the Euro USD and the British pound against the US dollar, which is a very economic currency pairs to trade because of the volumes they generate.
Right.
As opposed to trading US dollar, Norwegian, Norwegian crane, that will be very expensive because it's an exotic pay. So you can expect to pay a lot because the spread will be very wide. So these are all the factors you need to consider when you're trading. You need to factor in your trading costs based on your trading style, based on your trading instruments, and based on the frequency of your trading. But either way, you will pay something because the broker has to, charge for their services.
Yeah.
Just like the bank charges sort of bank fees for the savings account, for a credit card, there will be fees.
All right. There you have it to our friends and our listeners and viewers out there. Thank you so much, Sihle. In a nutshell, what Sihle is saying is there's nothing as a free lunch. So if you want to come to the party, pay the admission, and you know what you're getting from it. Do your research, know what it is you're getting into, what it is you're buying into, why you are buying into that. That'll serve your business very well. And often that is what a lot of the traders out there in different trading communities overlook, that cost of doing business. It's all a cost. There's nothing as a free lunch. Remember that point. Thank you for now. And remember to follow us on all our different socials, subscribe, like, and bye for now.
Cheers. Bye-bye.